Hello and good morning. I suppose it's morning in the United States when you will be seeing this session of A New World, Global Trends and Challenges for Receivables Finance and for Asset-Based Finance. This is a pre-recorded session, but we will be live taking your questions at the end. Don't hesitate to send your questions to the Q&A, and during the session we will be able to answer the questions live because we will be following this ourselves on the 11th of May. My name is Eric Timmermans. I will try to moderate this meeting today. I am the founder of World of Open Account. Before that, I've been very much involved in receivables finance. I'm also involved with the Tradius collections these days for the finance industry, and also in e-invoicing. So quite a broad aspect of receivables I'm involved with. And I'm very pleased to have a wonderful panel. We normally would have been last year at the IFA conference, which for obvious reasons didn't really take place, but we're very pleased now to have our virtual session here, and very pleased to introduce you to the panelists, Richard, Tony, and David. And I'm going to ask each of them to very briefly present themselves. So Richard, can I start with you?
Sure. Richard Hawkins, CEO of Atlantic Risk Management. We're a specialist lender services business operating in the asset-based lending, commercial finance industry across multiple continents, working on cross-border deals in relation to field exams and also workouts.
Thank you. And Tony?
Hi there. Yes, for 12 years, the Trade Advisory has been leveraging the network's expertise over 40 years in international trade, trade finance, logistics, and credit insurance, helping borrowers, investors, logisticians, fintechs, and professional advisors to develop new products, new markets, and sales.
Thank you, Tony. And then last but not least, David Taj.
Good morning. I'm David Taggi. I'm the principal member of David B. Taggi, PLLC. We're a law firm in Oak Hill, Virginia. It's about 25 miles northwest of Washington, D.C. Focus on business transactions, trade finance, and business litigation.
All right, so that's the panel for today for the next 50 minutes or so. And don't hesitate to ask us anything you want to know. We'll be very happy to take your questions. So it's quite a broad subject that we have taken up. A new world, global trends and challenges for receivables and also asset-based finance. It's quite a heavy subject, but we'll try to make it as tangible and concrete as possible. We have, of course, prepared. We have already identified a number of areas, but well, just to introduce this, so much has happened, of course, over the last year, as everybody knows, or maybe little has happened. It depends on how you want to see this. But there are some very, very clear trends that have been taking place also in the supply chains over the last 12 plus months. And the first one being a total disruption of the global supply chains, not only, by the way, due to the pandemic, but also to catastrophes and to Suez Canal traffic jams, and so many things have happened, but the traditional supply chains have very much suffered. This is really one of the trends which we will discuss, and how that will affect also the industry of receivables finance. We have seen massive government intervention, quantitative easing, which probably is going to come to an end. And then what? How will that interact, and how will that influence also the financial world and receivables finance as such? Another question we ask ourselves is credit insurance, a very important risk mitigator. At the same time, how will credit insurance be available once this form of support we have seen from governments to businesses, when that comes to an end? And many people are waiting and are probably quite nervous about the effects that those can have in the next few months. We also saw a continuing trend, because that's nothing new this year, that banks, and this is of course a general observation, are more and more pulling out of traditional trade finance for a number of reasons. That's happened since the financial crisis, for reasons of risk mitigation, capital requirements definitely as well. At the same time, lots of liquidity is trying to look for investment opportunities, and also investment opportunities in trade and trade finance. And that's how there are more and more initiatives in trying to link investors also with trade assets. Sometimes that doesn't go well. We have seen the Greensill story this year, and we also talk about that because you cannot do these days any event or any panel discussion on receivables finance without at least also covering the things that happened at Greensill. And then another trend is digitization. Digitization has taken place in such a faster way this year due to the pandemic. And it definitely also offers opportunities for trade and open account trade finance with bigger visibility, with new ways of doing business as well. It can also have maybe a negative impact when we look at the disharmonization or the disintermediation, I'm sorry for that, of what happens with the wholesalers. And that can be an effect also for factoring business, traditional factoring business, who is being disintermediated because of the direct business to consumer through the e-platforms and the e-commerce platforms. This is also one of the trends we want to talk about. So this is a little bit of scene setting as an introduction. These are the topics we would like to really discuss with you today. And I would like to start with Tony. Tony, you have some very strong ideas about this disruption of supply chains and how this has affected and will affect also receivables finance.
Yeah, thanks a lot, Eric. It's certainly been an interesting time. You know, the pandemic wasn't the only disruption to trade in recent times. As you mentioned, there were trade wars. The last administration in the United States had kind of a thing about global trade and felt that America was the center of the universe and acted accordingly. That fortunately is, you know, now on the wane, and we're participating again, which I'm delighted about. So tariffs, Brexit, you know, container ships getting stuck in the Suez Canal, as you mentioned, earthquakes, volcanoes, you name it. There are plenty. There's a whole flock of black swans out there, and it's an exciting time to be in international trade. So, but particularly the pandemic, you know, had a tremendously deleterious effect. It really highlighted the fact that one needs to diversify. You know, you can't have all your eggs in one basket, and Chinese eggs are particularly popular in terms of supply chain sourcing. And I think the lesson has now been learned and is in process to diversify away from China if possible. Maybe some reshoring thanks to robotics and you know, printing technology. Partly, I think also the number of suppliers, not having all of your eggs in one basket there. It's important also, I think, to evaluate the creditworthiness of your suppliers. Do they have the wherewithal to survive a situation where they can't get paid for a season? These were always given, but now these considerations are really critical. One of the interesting things is a challenge to the historical concept of, or the received wisdom of just-in-time inventory, keeping inventories really lean and mean. That didn't help very much in the pandemic. People got caught short. I mean, I don't have to mention right now, I don't know by the time this is live whether it'll abate, but you know, there's a great shortage of computer chips, and that has stopped production of car manufacturing lines, just to name an example. Raw materials are in critical short supply. The ports are all backed up. I mean, you know, what happened in the pandemic was that a whole load of container ships were stuck here. And then when China got to recover and wanted to and started to manufacture again, the ships were all in the wrong place. Plus the crews were suffering from COVID. the crews on the vessels and the port operations were stymied. That has resulted in a threefold increase, sometimes as much as 4 times the increase in global freight rates. So it's really very, very complicated. And there's a need for agility, looking at alternative logistics. There is also another thing that came out of this disruption, a very positive thing, in my opinion, is the readoption or refocusing on the critical need to digitize processes. You know, when you couldn't get someone to sign off on an approval in a bank to issue a letter of credit or sign a bill of exchange, which still, after all these years, has to be a wet signature, you know, people had to adapt, and they did. And the digitization of processes and documents has gone, you know, crazy. It's on steroids. And
we'll come back to that. I think it's, if I may interrupt, or just to make sure that also the sake of time, because digitalization is definitely one of the big elements on this in this discussion. We'll come back to that. But to come back to this disruption, supply chains, Richard, David, you want to add something to Tony's comments on this, Tony's observations? Or Tony, please.
I think Tony's observations are spot on, as always. And one of the things that's happened here is that Tony mentioned that there was a lot of money chasing opportunities. And I think that was one of the causes of what's happened here, for example, in Greensill, where you had lots of money that had to get deployed after SoftBank put it in, and there was not enough traditional supply chain finance opportunities, reverse factoring, as it were, to it, and people started doing different things that really were not supply chain finance, you know, effectively, you know, buying future receivables that didn't exist and stuff like that. And of course, that created the expected problems.
We'll come back to Greensill in a minute, of course. Richard, what are your views?
Yeah, so I think, you know, again, part of setting the scene here, if we're looking at, you know, the global world out there and what is going on as a result of the pandemic. Your first observation is that the post-pandemic world is the timing of that, depending upon where you are on the planet, is very, very different. We know that the United States is doing incredibly well, and certain parts of the UK is doing quite well in terms of getting people vaccinated. You have Europe that is slow, but has been lagging behind, but is gradually getting together. And then you have absolute catastrophes in the third world, a place like India. So we're still in a pandemic world, and as we move through that, the impact of the pandemic has been massive government intervention. There's been, the taps have continued to be turned on in terms of liquidity. The liquidity is still sloshing around out there, but at some point in time, those taps get turned off. At some point in time, businesses have to readjust back to a normal type of world where the flow of finance is not going to be there. And all this is going to happen at the same time. So as we're coming through this and we're looking retrospectively in terms of the impact of the pandemic, we're also sort of trying to look at what is next, what is going to happen next. So the disruption to supply chain, the disruptions to business, which is to a great extent has been insulated by government intervention in many, many countries. As that government intervention is taken away and as businesses start to begin to trade again, we're going to see a continued, very, very dynamic situation across the globe. So the supply chain disruption is something that we're going to be living with for some time.
The risks are going to increase. That's fair to say. That's something which is almost a certainty, I think. That and then
but it means, sorry, Tony, but yeah, it also means the risks are increasing, but it also means the spontaneity of being able to provide finance and meeting needs locally for your customers, for your clients, is also going to become more acute.
Tony, you wanted to?
No, I was just going to say, against this sort of backdrop of dire experiences in the pandemic, it's important to note that there's an optimism coming back. You know, merchandise trade is forecasted to increase 8% this year. That's phenomenal. I mean, the average growth is around 4%. That's what it's anticipated to be in 22. But that contrasts with a 12% decline in the Great Recession and a 5.2% retraction during the pandemic. So we're on the mend.
But how are we going to take advantage of this? I mean, it's fair to say when we're talking about cross-border trade, and I don't want to be too black and white here, but it's fair to say that banks are not really very eager to do trade finance. I think this is probably correct to analysis today. So what are the real alternatives? What can be done? How can that money be used in a good and risk-worthy way also to finance these supply chains? Any comments on that?
Well, there's been lots of really big platforms, very robust platforms have been built over the last 10, 15 years that are going to be used and even better. I mean, you could look at Prime Revenue, you could Talia, Orban, you could go on and on and on. Drip Capital, you just name it. There's been all these people who have incredibly robust platforms, and those platforms are going to be used, and a lot of fintech money is going to be flowing, to those platforms to help, take up the slack. And here in the U.S., the Federal Reserve has certainly said, look, we're going to keep being accommodative on financial policy as long as we can, to not to have a sort of a sudden chop off, and the government credit all disappears all at once, and everybody goes, now what do I do? So, the idea is to hopefully it will all eventually recover over time.
So there's still space also for supply chain finance and reverse factoring, and let's maybe have a look at that. Let's have a look at the elephant in the room, at the Greensill saga. Maybe who wants to comment? Richard, you want to make your analysis as a risk specialist, and how do you look at this with external eyes a little bit, and to say, well, what went wrong, and then why didn't we see that, or have we seen it but didn't we want to see it because of the emperor's new clothes?
Yeah, I think Greensill is not indicative. Greensill is a combination of events. One huge liquidity, money made available to it, so which tried to deploy. The normal rules of engagement in relation to the products that it was supposed to be offering were distorted significantly, and which has led to the situation that we've now seen. So, most of the problems that have come out of Greensill would have been identified with the standard lender finance audit, which obviously never took place. The categorization of the different types of activity that the business was involved in, and testing those transactions against what would be the norm, and that didn't happen. So, I think Greensill is a one-off. It is the elephant in the room, and it's caused a lot of concern. There's still a lot of print out there in relation to Greensill, but I think we have to sort of see Greensill as a one-off to a great extent, in that the practices were engaged and employed there were, to say the least, unusual. Okay. I think Tony's got some good comments on Greensill as well.
Oh no, not really.
Go ahead. I know you have, but please go ahead, Tony.
No, I mean, I agree. Look, this was an overambitious attempt on the part of Greensill to revolutionize the space. And it wasn't helped by the fact that it was the pressure to put out $1.5 billion, which then became $2 billion of investor money from SoftBank. And really, the big mistake, I think, is that they just, didn't focus on their core business. They didn't stick to their knitting. There's nothing wrong at all with reverse factoring. It's a critical technique. But when you start, financing aircraft and you start, doing payday loans for the NHS, and you start financing receivables that don't exist against purchase orders that haven't been issued from buyers that don't even know the supplier, you are doing a tremendous disservice. You're disrupting your own company, never mind the industry and the technique. And it blew up. Yep. The other thing is there was a whole lot of confluent aspects of this. Credit insurance, I mean, that's another thing here. All of the credit insurance exposure was in one basket, a company called Tokyo Marine. Their underwriter actually apparently misbehaved and went way beyond his pay grade in underwriting risks that were not permitted within his authorities. Incredible. They withdrew coverage because there were bad debts. But within the funds that Credit Suisse investors put their money into, was it really known what the commingling of assets were in these funds? Did credit insurance really check to see what was in the basket of assets? So those are a number of other observations.
Okay,
If you
David,
think
yes.
of supply chain finance, also known as reverse factoring, and they've written a set of documents for that's been in use here in America for the last 5 years, and very successfully by my client. So they've done very, very well with it. And what you have here historically is you have and it was developed by the money center banks in New York and London and some other places. And they went out and they said, we need to make ourselves relevant as the world is moving away from trade documents to open account. And we are going to go ahead and we are going to finance, we're going to look at the supply chains of clients of the bank that are Fortune 100, 200 companies or whatever the European equivalent, and you are going to go ahead and say to them, look, you guys can make a lot of money by taking your terms of sale, and rather than paying in 30 days, you can put about 60 days or maybe 90, whatever it is. And so that's one time pure cash to you. So that's a win for you. Now your suppliers are going to scream because say, wait a minute, what am I going to do? I need to get paid in 30 days. I don't have the cash flow to survive for 90 days, as Tony was talking about. So what they did is they set up these platforms where you had Citi and these other major banks and say, all right, look, I'm going to go to the approved suppliers and I'm going to buy the really sterling, credit, the payables of these very large companies, and I'm going to buy them at a discount, and then I will collect on my money at maturity. The credit risk is really low. It's a good deal for me, for the bank. It's the supplier, because yes, they get hit with a discount, but they do cash right away. And all this is done on electronic interchange, where as soon as that approved payable by the large company is approved, then start to happen. The money changes hands. But as Tony said, what happened here is that, that is sort of was, as other people got into the business, that became a lower and lower and more competitive margin. So it was profitable and it made sense. It added a lot to world trade. But it didn't give you enough, of return when you started going and doing crazy things.
I think we all agree indeed, David, and I think it's quite, certainly for the insiders, it's quite clear that Greensill saga went way beyond traditional, very almost old-fashioned reverse factoring, which is a very stable and not risky technique. Of course, it has this...
Eric, just one quick point. The key thing with reverse factoring is a concentration of credit risk. You had that one large company, and if the large company was big enough, the idea was that there's no credit risk or very little.
Of course, yeah. Well, and
that's what made this thing work. But as you go down into smaller companies, you do like buying future receivables, you have more credit risk in the process.
Sure. Which brings us to a number. I would like to discuss two questions in that respect. Let's forget about Greensill as such, but what does this panel think about how investors, we discussed at the beginning that investors are looking and their liquidity is out there. Will this affect maybe the appetite of investors to enter into trade finance assets, or do you think that's not really the case? Linked to that, securitization, will this of trade receivables, will this have an effect, or any ideas in that respect, or is this still a no-brainer, and will these industries continue to flourish?
Yeah,
Richard, maybe.
Yeah, I don't see any impact upon the securitization world other than that a lot of securitization platforms are predicated on the idea that the beneficiary of the advances is actually an investment grade or sub-investment grade business. And what has changed as a result of the pandemic is that certain of those investment grades have certainly deteriorated, and the sub-investment grades have deteriorated even further. So the securitization world is left with a challenge in terms of what does it do in relation to the hundreds of billions of advances against often receivables in relation to those, and in relation to those covenant breaches. My experience of that is that they are rolling those facilities on, and they are not taking aggressive action in relation to those covenant breaches. That is where we are right now as far as securitization is concerned.
Okay, good. Tony, you wanted to add something? Or?
I don't think I think the market is falling in love. I don't say fallen, but falling in love with trade as an asset class.
Okay.
It took a hell of a lot of persuading. It's unbelievable that people were so confused about what international trade is, which is frankly a very simple thing. There are complicated parts to it and processes, but the world has been trading globally forever. What's interesting is that the banks didn't want to quit trade finance. They're suffering the consequences of misbehavior during the crisis, and then got lumbered with and hammered with regulation. They were forced to quit. This was like manna from heaven for non-bank funds that were looking at the risk, superior risk-adjusted return that was not correlated to the stock market. As long as yields are decent and risks are good, there will be plenty of people signing up for securitization. The real challenge is going to be to get beyond payables and receivables, which is the easy pickings, and get to where the real fun is, which is inventory. We'll get to that in a moment.
Yeah, we come back to that indeed. Yeah. Right.
And I would agree with Tony and Richard just briefly. I think that's the real thing is going to be on due diligence. People are going to have to understand, do a better job of due diligence to know what the money is being used for and how it's being applied.
Yeah. Well, one of the things that we touched upon is credit insurance, and this can also be interesting, I think, for the IFA members. Well, any ideas? It's of course something extremely important into risk mitigation, but it also has its limitations. That has been seen also in the green. So, any comments on this, Richard?
Yeah, I'd like to. Yeah, I'd like to a couple of observations generally in terms of what has been happening to the credit insurance industry. If you go back 10 years, the credit insurance really was incredibly rare in the United States, and they've done a pretty good job of infiltrating. Part of that was driven by the fact that they messed up their reputation in the UK, in the UK and Europe, in terms of their reaction to the last credit crisis. And so they saw the US as new ground where they didn't have the same reputational scarring that they had from that. What we see now is credit insurance, which is embedded within the receivables finance securitization industry, the factoring industry in Europe, is that the credit insurance have been supported by governments. Governments have taken over the limits. They've back guaranteed the credit insurance. So whilst we've seen the deterioration of credit quality across many companies across Europe, what we will now see is that the governments will start coming off risk. And as the governments start coming off risk, is going to be at the same time when we're going to start seeing businesses trading out of the pandemic. So we're going to see quite a volatile situation, and it would be interesting to see how.
Oh, I think we've lost you, Richard. I don't know if we've lost you entirely. Let's maybe.
I can see me.
Okay, you're back. You're back. So, all right, maybe you can just rewind your last thought.
Sure.
And,
yeah, I was just saying that it'll be interesting to see how the credit insurance industry reacts as they come back on risk, and as they're now presented with credit risk in a completely different environment, which they have been to a great extent sheltered from over the last 12 months. That may impact upon credit insurers' attitude to the industry and financing and backing up the receivables and factoring industry in the United States.
all right, thank you. Other comments on credit insurance from David or Tony? Tony?
I think that we're in danger of having too much reliance on credit insurance. One of the reasons why payables became an asset class that institutional investors could invest in is because the requirement that some third party, namely a credit insurer, put a credit enhancement wrap around it was there. It was like a crutch.
But that's a little bit linked to what David said. It's a concentration, and if this mid cap, not investment grade, and then you try to cover up a little bit with credit insurance, but that's almost against the traditional way of credit insurance, which is also based on a spread of risk on a total portfolio, not on a concentrated risk on one buyer. And isn't that maybe the difficult marriage between reverse factoring and credit insurance? Whereas for more traditional factoring, I think it's a good risk mitigator, but that's my personal opinion, which I shouldn't have as moderator. I'm sorry for that.
No, you have very valid opinions, Eric, and we can certainly change places, because I'd love to hear more about your views. But the thing is that I think that, you know, credit insurance is doing the job that credit underwriters in normal circumstances should have anyway. And the issue is with the, you know, some of the Greensill points we were mentioning, is that where was that? Was that properly done at the fund level and at the originator, at the Greensill level? And if you apply, you know, credit criteria to sound and commonsensical underwriting, there may not be the need for a credit insurance. In fact, many people self-insure because they feel that that's their core competence. And that used to be the core competence of banks. When I was in credit insurance in the 70s, I started my career in it. Credit insurers did not want to have financial institutions as insureds.
Yeah, absolutely. Yeah.
And one of the things too that's come out of Greensill on credit insurance is that, you know, there was excessive concentration risks, for example, in Mr. Gupta's companies and stuff like that. And they may all be good in the end, but you have to recognize that in supply chain finance reverse factoring, you have a sole credit risk. It's not spread. You're looking at that one group of, you know, payor or payors. The other things that comes out of it, I think, is that to the extent that you were funding future receivables and things of the like, that's probably, I can't believe that a credit insurer would write a policy knowingly and fund that sort of stuff. Now, maybe it did, but I kind of doubt it. So I find, you know, that you know, a lot of litigation over that. The credit insurers are going to say, that's not what I agreed to do.
Yeah, I think the other point that comes out of this, chaps, is that, you know, there's been a tendency to wave away all of the things we do to establish the risk, and we believe that credit insurance wipes out all of the risk, and it doesn't. It only mitigates the credit risk. It doesn't mitigate performance risk. Yeah. And so, you know, and if there hasn't been any performance, the contract is invalidated, the goods haven't been delivered or supplied or in accordance with the contract, then the credit insurance is irrelevant. And I think there's been a tendency to try and oversimplify the financing of receivables by saying, okay, don't worry, it's credit insured, we can all go home.
It's non-recourse, so there's no risk. Yeah, well, and everybody knows that there's risk also for other reasons, indeed, and credit risk on the buyer, absolutely. But let's move on, for conscious of time as well, and let's talk a little bit about digitization in general, but also I see that Tony absolutely is very interested in, for good reasons, to talk also about this other part and the easy part of receivables and to go into inventory, but digitalization in trade and trade finance, and how will artificial intelligence influence Internet of Things? You have already mentioned also, Tony, the printing on demand, so the whole visibility on the supply chain you will talk about. But David, I think you wanted to share first some thoughts about
just
what
briefly,
we expect in this space.
Sure. There are major implications for factors as supply chains become digitalized. So in a digital supply chain, it can refer to either the digital aspects of a physical supply chain, or it can refer to a chain of technology companies who are participating in the delivery of digital products as part of a particular supply chain. And what it involves, as you guys have said, it involves the use of advanced technology, blockchain, Internet of Things, artificial intelligence, machine learning, predictive analytics, all these things working together to come up with a better supply chain for everybody. And the key on all this is tracking data. And as we all know, in a supply chain, risk management and mitigation and payment are all tied to discrete events, whether that be a purchase order or a pre-shipment inspection or the shipment of the goods. Invoices are issued, when the goods are accepted, et cetera, et cetera. And the idea of digitalization is to capture all this information in the supply chain platform and make it available to everybody across the platform, okay? Everyone who's vetted, of course.
Sure.
That way, you know, everybody has access and they can see the orders, the productions, the shipping milestones. They can see the electronic bills of lading, the cargo details, the trade documents, the sensory and the performance data as to where the inventory is, and et cetera, et cetera, et cetera. So it's big. And their platforms today do all those things.
So it's not a dream, it's reality. And I think Tony...
You're right. It's not a dream, it's reality.
Mm-hmm.
And I think that there are implications on that for factors, because factors are going to, there may be less demand for factors. The more this happens,
Mm-hmm.
Demand for factoring eventually, could get influenced.
Yeah. So how to move towards this purchase order or inventory? I'm a traditional factor guy, and I've always told you can only finance as from the moment that the buyer has received legally the goods. But how can you do that before? Tony, you have some ideas on this.
Yeah, I think a couple of things. First of all, I think the purchase order is going to become increasingly important. Mm-hmm. It's the start of everything. And by the way, it's not going to be, sent by email. It's going to be issued digitally over a procure to pay platform. Many of those now in existence. A couple of them like Coupa, SAP Ariba, the TradeStream. A lot of these are now becoming prevalent. And
I just can make a very short, and I know it, I don't want to make publicity for e-invoicing, but since I'm involved with e-invoicing, I'm surprised about the lack of understanding of the receivables finance world of the advantages that a structured invoice that goes readily from the system, from the seller into the buyer system. It has so much advantages also in terms of visibility. But sorry to interrupt. But
no, but that's exactly the point. And so there is an implication that it's an imperative that factors be a part of that. You've got to insinuate yourself into these platforms and provide the early pay or provide the credit underwriting of the customer. But the other thing that I was going to say is that because of digitization, the hitherto siloed functions of trade, the trader who trades, the logistician who moves the goods, the financier who finances it, and the IT department, with whom no one understands what the hell they're talking about, that is all coming together in such a way that the whole supply chain is becoming visible in upstream tiers, tier 1, tier 2, tier 3. And you need to know that because you need to know a problem way ahead of time. That will help the factoring world in terms of the performance risk. But the important thing for the factors is that more and more, with e-commerce becoming prevalent, there's going to be more reliance on inventory because companies like Amazon, companies like Wayfair are basically using the AI trade data to predict what people need and then have it ready for them. And that's what they're selling to importers and wholesalers. And the trouble is that the importers and wholesalers are not going to be given an order to bring goods in. They're going to be told to bring stuff in, and I'll buy that inventory from you the minute before I sell it to Eric. So there is a huge reliance on cross-border inventory. And it's not a surprise that in this week, Taulia announced that they were going to add inventory ownership financing to their payables and dynamic discounting platform.
Okay, interesting.
And I think Tony's exactly right on that. Inventory financing is going to grow and grow and grow. And you've got these incredible platforms of information that'll let you do it. So you track, for example, when goods are shipped. You can, so in Asia, you know exactly where it is at any point in time. You know when title is transferred. You know the condition of goods. You know the temperature, the humidity, or whatever it is that you're trying to track. You get all these things on this platform. You can know the security. For example, you can say, was this container opened? Okay, if so, where and when? You can react in real time to the problem. And the technology is just amazing, and it's all happening before our eyes.
But at the same time, a challenge for the traditional factor who is doing his traditional wholesale client towards the retailer, and he may really be disintermediated, if I understand that correctly, Tony. And okay, Richard, any comments on that evolution also in terms of digitalization? Or
I think I think that the Brave New World is coming, but it's not here yet. I think that, I think the factors have got to move down the supply chain, and they've got to start becoming cognizant of how inventory works and how inventory is managed, in order that they can start meeting the demands and the requirements of their clients and their new clients. So I think we are there, but there's certainly the direction of travel is to a digitalized world. But in the meantime, there is still the need for a greater understanding of the supply chain, as opposed to just believing that you can just accept that somebody's going to send you an invoice and you can advance against it.
Yep.
And I think another major thing that's coming too is security. You don't want to go ahead and be sharing all this inventory data, whether or not Bluetooth or SKUs or whatever it is you're sharing here, where the bad guys can tap into the same technology and get all the information. So you're starting to see companies that go and provide military grade security through the Internet of Things, and to provide reports on a secure basis that people cannot tap into. And I think that is one of the big developments that's really starting. You're looking at sort of the second generation Internet of Things, as it were. And that's going to be big, because this identified probably 20 years ago. Governments and industries, rail, for example, in the US being one, who are saying, okay, I need to go ahead and come up with a standard system that's going to be used nationwide, that's going to be able to track all these things on a secure basis. Where people.
Okay. Gentlemen, time is flying. I see that we are almost at our 45, 50 minutes. So maybe just time for one last question before we wrap up and bring this to an end, knowing, of course, that we can still take questions during the live session in 2 weeks' time. Well, 2 weeks' time, not for you when you are watching this. That's a very stupid remark, I admit. But it's still a little bit funny as well. So, Tony, what do you think? And that's maybe the question I would like to ask all three of you. What's the message, if you have a message, for the people who are watching this, for the IFA members who are doing their factoring business? What would be your key message, looking at the global trends that are taking place in this world of trade finance and global trade?
So I've got four suggestions. First of all, befriend technology, particularly digitization. You mentioned e-invoices. Just make sure you understand the processes and that technology. Capture or partner with platforms. Capture to gain access to trade data. Capture that trade data. It's really gold. Seek out niches. Some of the factoring companies that, for example, factor media invoices, that's really cool. Find cool spots to specialize in. And finally, get into inventory financing.
Okay, thank you. David?
I would share what Tony said. I think all those things, you've got to be involved as a factor. You've got to be involved in technology. You need to know it. You need to insert yourself into the process. You need to know what your clients are doing and show you can be a valuable addition as part of the platform. And I think, as Tony said, inventory financing is going to be big. It's going to be increasingly bigger. Focus on that.
Thank you. And Richard?
Yeah, I find it difficult to add much to that, except that, get close to your clients and get closer and closer to your clients. Get to understand what their business needs are, in order that you can provide the solutions that are going to work in the future, as opposed to today and in the past.
All right. Very wise words. And I would like to thank my fellow panelists for your very good and hopefully very interesting insights on the other side of the pond. Thank you, Tony. Thank you, David. Thank you, Richard. And I wish everybody there in Phoenix, that is it, very nice conference the coming days. And hopefully we will be there in real life next year. I don't know where it's going to take place, but I really cross fingers that we all will be able to meet you live around a good beer or a glass of wine. So thank you very much, and have a good conference. Thank you. Bye-bye.
Thank you.
Thanks, Eric. Thanks, Eric.